the requirements. They are asking us to advise Kenduri on the recommended and advise Kenduri and recommend an appropriate hedging strategy for the cash flow to receive open 3 months. So this is going to be, I think, FX, because we are going to be receiving or paying some amount of money in 3 months' time. So, and we're going to advise and recommend. So usually now that's going to depend on the options that are given to us. So they may have given us the FX where we can go and get a forward rate. Then they can also have given us futures. They can have given us also options, collars, swaps, and so many other things that can come. So shall get that from the scenario. And then we calculate using a tabular format, which is the transaction matrix, the impact of undertaking multilateral netting. So this is going to be similar to what we saw yesterday. So we are going to look at multilateral netting and by Kenduri and the 3 subsidiary companies for the cash flow. Briefly discuss why some governments allow companies to undertake multilateral netting while others do not. So there's a theory part here which tries to look at why companies or why governments allow multilateral netting while others don't. Of course, there is some marks for professional skills, which you get basically if we are answering and we are putting, in this case, analysis when we are calculating an evaluation, skepticism, which you come up when it comes to discussing why some governments accept, others don't, and also business acumen will come in there. So now if we go to the scenario, they say that Kenduri is a multinational company which is based in the UK, and it has a number of subsidiary companies around the world. So currently, foreign exchange exposures as a result of transaction between Kenduri and its subsidiaries managed by each company individually. So this is what is happening. Currently, each company manages FX exposure, but Kenduri is thinking so that maybe they can manage the foreign exposure using multilateral netting from the UK with the sterling pound as the base currency. If multilateral netting is not taken, the spot mid rates will be used. So the foreign cash flows are due in 3 months between Kenduri and 3 of the subsidiary companies. We have the companies Lakama based in the United States using dollars. We have Jaya in Canada using Canadian dollars, and we have Bosch Japan using Japanese yen. So we have these cash flows owed by and owed to the assets. So then we have the exchange rates that are given. So we, like I said, we have a spot. Then we have also a forward rate. Then the spot mid rates, which should be used in the multilateral netting calculations, are given here. In case we do multilateral netting, these are the mid rates. Then we also have been given options. So we have options. And then also we have annual interest rates available, Kenduri. So now, when you have these interest rates, you can look at a money market hedge. Money market hedge. So you can look at that. So now, remember they're saying that at the moment, each company is dealing with their own cash flows. So because that's the case, and they're asking us to advise Kenduri on the appropriate hedging strategy, so we are going to look at Kenduri only. So now, if you look at where Kenduri is, it has, we have here Kenduri Then we also do have it here and here. So now we have it here, dollars. Remember that Kenduri is based in the, is it based in the UK? Let's see. Yeah, Kenduri is based in the UK. So all of the transactions that we are seeing here with Kenduri do not involve UK currency, but let's see. So, but we have the rates here, okay? Converting from US dollars to euros, or to actually to pounds. So that means that these are the transactions that we are going to be dealing with for the first one of advising Kenduri and recommending the appropriate hedging strategy. So all these cash flows are due within 3 months. So now they are saying, oh, actually here they told us to only look at LACAMA, okay? Only LACAMA. They're saying advise Kenduri Co and recommend an appropriate hedging strategy for the US dollar cash flow. It is due to receive or pay in 3 months from LACAMA. So which means that we are not looking at even all of these ones. We are just looking at this one here, Kenduri LACAMA, and also here LACAMA Kenduri. So let us go and start our calculation. Okay, so the transactions, now remember, Kenduri, because we are going to just pick those transactions. Owed by, then owed to, then we are going to look at the currency, and the currency here, dollars, and we are having dollars millions for these two. Now, so Kenduri, that one is owed to LACAMA, and it's 4.5 million. Then the other transaction which has Kenduri and LACAMA is here, LACAMA, Kenduri Co, 2.1 million. Now, so if you are doing netting, remember what you are owing is a payable. Okay, this is 2.1. What you're owing is a payable, and what you owed to is a receivable, like we saw yesterday. So if you put a minus on the payable and you leave the receivable positive, means that the net amount that is payable, because it's a negative, is 2.4 million. Okay, which means that Kenduri is due to pay $2.4 million, 3 months. Okay, is that part understood? You are clear on that part?
Yes.
Yeah. So now we are going to deal with the different options that are available, and one of them is the forward market. Now the forward market is always easy. We normally, since we are going to pay that money in 3 months, so we shall use the 3 months forward rate. Now, remember, we are going to have to pay dollars, so we are going to have to determine what rate. So if you are going to pay dollars, means that you're going to have to buy dollars, or in other words, you are going to have to sell your pounds. So the way these rates usually are, we are using this rate here. So the first rate is always for buying the base currency, and the base currency is this case, the pound. So the first rate is the one for buying the base currency, and these rates are for the banks. So the bank buys pounds at 1.5996, and the bank sells pounds at 1.6037. Now, because we are going to have to pay dollars, we are going to have to sell our pounds. So if we are selling our pounds, the bank buys at 1.5996. So that means that that's the rate we are using. So the rate 1.5996. Now, because we are converting to pounds, which is the base currency, we are going to divide. So therefore, the dollar payment just going to be $2.4 million divided by 1.5996, which gives us 1.5, and that 1.5 now is million pounds. So that is pounds. That is the forward market. Now, the other one that we have, because they also gave us the options, so we can use options. Now, so for the options, what you need to do is to look at the contract size. The contract size is given to us in pounds. Now, remember, if you're going to have to sell pounds that we have seen, that means that you are going to have to buy put options. Understand that part? Because the contract size is in pounds, and we have identified that we need to sell pounds. So if you're selling the currency of the contract, then you have to buy put options. But if you are buying the currency of the contract, then you buy call options. So that's how you make this distinction when it comes to FX.
I beg your pardon.
Okay. So the currency options and futures normally have a contract size. And the contract size is given to you in a given currency. In this case, it's given for us in pounds. So, and we have already identified from the first part is that since we are going to pay dollars, we are going to have to sell our pounds to get dollars. So in other words, we are going to sell the currency of the contract. And if you are going to sell the currency of the contract, you buy put options, because remember, put options are the options to sell. You understand that?
Yes.
Yes. So means that here we are going to buy put options. Now, which put options? Because they have given us, okay, here they didn't give us different options, so it's okay. Because remember, the options that we are going to have to buy would be options that are expiring. Oh, actually, we do have the ones of 3 months and the ones of 6 months. So remember that we are going to have the transaction happen in 3 months. So that means that we are going to deal with the one of 3 months expiry. So we are going to buy 3 months expiry put options. Those are the ones that we are going to buy. So just like we said yesterday, we would need to now determine the amount that we are going to determine in terms of contract size. So what's the contract size? For the contract size, we are paying 2.4 We are paying 2.4. So now there are two prices given to us. There's one of 1.6 and there's one of 1.62. Okay, so we need to determine, like yesterday we did for both of them. So here, even here, we have to do for both of them. So we are going to have to look at them and see. Okay, if we start with the one of the exercise price of 1.6, this is $1.6 per £1 USD per pound. That's the exercise price of 1.6. If we start with that one, so the contract, so we need to first of all determine the contract. What number of contracts? How do you determine number of contracts? Remember, we are paying $2.4 million. Now those ones, we have to first convert them to pounds because the contract is being given to us in pounds. So divide that one by the exercise price of 1.6. Now on that gives you 1.5. So then you divide that one by the contract size of 62,500. So that gives us 24 contracts. Those are the 24 contracts that we are going to have. So now, of course, now when you have 24 contracts, then remember we are going to start with the first one. So we know that we are going to buy put options, 3 months put options. So this is the premium 2.08. Okay, but this is 2.08. The premium which is here is given to us as cents per pound. So these are 2.08 cents. And remember how to get the dollars, we divide by 100. So the premium is going to be 2.08 divided by 100. That gives us the dollars. Then multiply it by 24 contracts. Multiply it by the contract amount, which is 62,500. So that is the premium that is payable, right? Now, but this is going to be in dollars. This is premium paid in dollars. So 31,200. So we can now convert it pounds. So how do you convert pounds? You just, of course, divide the amount in dollars by the rate. And the rate is this rate here we are going to deal with. Let's see, do we have that rate? Because when you are paying that, you are paying it right now. So you convert using the spot. Premium is paid right away. So we are going to use the spot rate, which becomes 1.5938. That is the premium in pounds. So then what's now the total payment? Total payment is going to be the amount that you are paying, because now this is, remember the payment is going to be 2.4 million. Okay, but then you convert that one using the rate. We already have that worked out. The rate was 1.6. That's the one that we are using. So that gives you in pounds Then you add the premium which is payable, which is this 1.9. So you end up paying 1.519575. So this is the total payment if we are looking at the exercise price of 1.6 pounds per USD dollars per pound. So far, are we following on that?
Yes.
Okay. Then now we can look at the same thing. We can actually just copy this and edit. So if it's now 1.62, which means that we are using 1.62 here. So that gives us, when we are using 1.62, it gives us 23.7. Remember, this one was exactly 24, but these ones are coming out 23.7. So now, when you get a figure which is not a whole number, you have to round off. And when you round off, you can either use 23 or 24. So if you use 23, then you have, if you use 23 contracts, then you say you have underhedged. Okay? Because ideally, it's not 23, it's 23.7. So you have left some amount unhedged. And if you use 24 contracts, then you have overhead. So that's the two scenarios. You can either underhedge or overhedge, or have a perfect hedge like this one where we got perfect hedge. So if you underhedge or overhedge, usually you should correct for that under or overhedge. But it depends really on whether you have time in the exam and therefore you can be able to proceed through. But if you can't, you can just note that you have underhedged and proceed. But here we are going to look at it. So let us go with the underhedge. You could have chosen to go with the overhedge. So if you go with the underhedge, we are going to deal with 3 contracts. So the premium that you pay is 3.42, 3.42 divide by 100 to make it dollars because it was cents. We multiply it by 23 contracts. That's the premium of 49,163. Then you convert it using the spot rate to get pounds. So that becomes 30,846. Now before we proceed, we should now look at the underhedge because we had some underhedge. So what's the amount that is not hedged? So now remember, to determine what was not hedged, you know that you are supposed to hedge 2.4 million. Okay, but how much have you hedged? You have hedged 23 contracts at 62,500, which is the contract size here, okay, at 1.62. So what you have not hedged is 71,250. Okay, and these are USDs. So you have not hedged it. So what normally happens is that what we do is that we can hedge the amount not hedged using the forward rate. So whatever is not hedged, use a forward rate to hedge it. So, and we know how we do the hedging using forward rate. We already did an example. What we just do is get this amount. So you can just put it here. We are just going to get this amount in dollars. And then you divide it by the rate for the 3 months forward, which was 1.5996. That gives you 44,542. These are pounds. Therefore, what's the total payment?
Hello.
Yes.
I was wondering if you could go back to how you computed
This one?
the amount of 23.
0.7.
No, no, the when you were trying to compute the amount not hedged.
Oh, the amount not hedged. Okay.
Yes.
So let us break it down here. Okay. So the USD amount to pay is 2.4 million. Okay. 2.4 million. Now the USD from the USD hedged, remember that we have hedged using 23 contracts, and each contract was at 6,500, and then we are hedging using 1.62. That is how much we have hedged. So we're supposed to hedge for $24 million, but I mean 2.4, but we have hedged only for 2.328. So the difference between these two is what you did not hedge, 71 to 50. So here I have just put it on one line, but that's exactly what we are doing. We are looking at supposed to pay $2.4 million, but with our current hedge, we have hedged 2.328, leaving this 71 to 50 not hedged. Okay?
Yes.
Yeah. So the total payment is going to be the premium that we pay in pounds plus the amount that is hedged using the forward rate. Okay? Then did we? No, we didn't put the premium paid in pounds because what we have put here. Okay, it's fine. So the amount is going to be, because now the total payment is going to be some something that we didn't put here, I think. See? Yeah. So we did the total payment includes the amount itself that you're paying, right? So just remove this line. So how much are we paying? Remember that we are going to be paying, we are using 2.4 million. So we have here 2.4, then plus the premium plus this other hedge. 2.4 we have to divide. So first wait. You have to divide it by, this is in dollars, so we have to divide it by the rate, 1.62. Yeah. Which becomes, but with this one, we are not hedging the entire figure of 2.4. So let's change this one. Let's put the 23 contracts multiplied by, because the amount that we are looking for is this 2.328. That's what we are hedging with that part. So 23 contract times 625, 62,500. Then you multiply it by 1.62. Then you add on that the premium, and then you add on the other hedge for the remaining amount. So which becomes Just a minute. Yeah. So sorry, here we are looking at only pounds. So you didn't have to multiply by the exchange rate. So the premium is in pounds, and also what we have here is also in pounds, which means that we just need to get this 23 contracts times 6,500. So this amount is also in pounds. So this is the total payment of 1.512. So now, of course, we are going to compare with one more thing, but at least for now, for these two, you would go with this second option because you're looking for the lowest payment. So you would go with this option of using 1.62 exercise price. So now let's do the money market hedge. Remember the money market hedge from FM?
Yes.
Yeah. So if we expect that we want to pay, because remember, we want to pay 2.4 million dollars in 3 months. So the first step would be to borrow some, because remember what we are going to do is that we are going to convert, we want to pay $2.4 million in 3 months. So we are going to have to convert in 3 months time, but we don't want to reach 3 months. So we would prefer to convert now. So what means is that you need to convert right now from pounds to dollars. So we are going to have to borrow some pounds now. That's going to be step one. Borrow some pounds now. Then step two, convert the pounds to dollars at spot rate. Then step three, invest the pounds. Okay. I mean,
Hello.
invest the dollars. Yeah.
Before we continue,
Yes.
there is a part that is confusing me. For example, under where we exercise the price 1.6, we
1.6.
first converted the amount payable into euros because the contract size is in euros, right?
Yes. Yes.
Then after doing that, we got the number of contracts,
Yes.
and then the converted value, which was 1.5, to get the total payment, we got the 1.5 plus the premium. But now, when we try to exercise the 1.62, we applied the same principle where we're getting the 2.4 and dividing it by 1.2.
By
Then we ended
1.62. Yeah.
1.6, so ended up with a figure 1.481
Mm.
something. So we use
Yeah.
that figure to get the number of contracts.
Mm.
But then my question is,
Mm.
would someone be wrong if they got the figure they converted into euros, which was the 1.481, and added it to the premium and the amount that has been the amount unhedged
Yeah.
to get the
Okay.
total payment?
Okay. The reason why they would be wrong, see, in this first one, when we got the contracts, they are exactly 24 contracts. So even if you multiply 24 by 6,500, you will get the same figure. But here we got 23.7. So that's why we don't just use the figure that we got up to add it to the premium, because we are only using 23 contracts, because some part of it, this last part here, the 71,250 was not hedged properly. So if we had used the same figure up, then it would mean as if we have hedged the entire total figure at once. So now we would be double counting by adding back this 71,250 converted to what? To pounds. So that's why, because you see, if we do 24 contracts by 62,500, you get 1.5. So that's why it works very well here. Okay, because if you divide this one, you get 1.5. But here, if you do so, you don't get exactly 1.5, because the number here is also it's not like perfect. It's not a perfect hedge. So that's why we here to preserve whatever we have hedged, we just use the contracts and 62,500. So if you do that 62,500, multiply it by 24 contracts, and then you add the premium, you get the same figure, you see, on the part of the 1.6, because it's a perfect hedge.
Oh,
So
okay.
ideally, this is what you should be doing to show that this is what you have hedged. And then that's what you have also done on this one here.
Oh, okay.
Okay. So now back to these steps. Okay, we want to pay $2.4 million in 3 months. So step one, we will borrow some pounds, then convert them to dollars, and then invest those dollars for 3 months. Now, I put those steps like that, but if you go and look at how they answer these questions of payments, they start by investing, because you need to know how much pounds to borrow, and that the only way for you to know is by first of all knowing how much do you need to invest. Remember, we need to have 2.4 million at the end of the 3 months so that we can pay. So need to determine the rate. So the rate
Wait,
becomes yeah,
hello?
yeah,
Okay, under money market hedge,
yes,
I thought when you are going to receive,
yeah.
you would literally do the steps you have written where you first borrow now. Because I thought if you're going to pay, you first invest.
Yeah, and that's what I'm saying, that okay, I think you know the steps backwards, because you see what I was telling you is that you cannot invest without borrowing. You get the idea? So ideally, the steps you follow when you are going to pay is that you invest, but then if you think about it, you can't invest money you don't have. So ideally, you have to first borrow the pounds, then you convert them to dollars, and then invest them. The difference is when you are going to receive dollars, you would borrow dollars. Get? But here I'm borrowing pounds because I'm going to have to pay dollars. So I want to have the dollars in 3 months, but I don't have the dollars now. So I borrow pounds so that I can convert to dollars and invest the dollars. But when I'm doing the steps, I come from down going up. So it's okay for you to know it like that. Invest dollars now, convert pounds to dollars, then borrow pounds. It's fine. Just that it makes logical sense to think of it this way. So it will depend on what you want to remember. But I'm going to also do coming from step 3. So it's basically what you also were saying. Just that it makes logical sense to arrange it like this. So now we are investing in dollars. So United States investment rate is 3.1%. So 3.1%. But we are going to invest for 3 months. So you do 3 over 12. So that becomes 0.775%. So the US dollar invest going to be, remember I want to have 2.4 million. So you divide this one by 1 plus 0.775%. So we have to invest 2.381543. That's what we want to invest. Now we can now determine the conversion. Okay, how many pounds do we need to make those dollars? Remember that we are going to convert pounds to dollars. So we are going to sell pounds at spot. So if you go to the spot, we are going to sell pounds. So the bank is going to be buying from us at 1.5938. So we are going to go to the rate 1.5938. So then the GBP going to be, so 2.38 divided by 1.5938. So that means that we need to have 1.494254 pounds. Now I know what to borrow, so I can now come and borrow here. So the rate for borrowing in pounds is 4.0%. That is times 3 out of 12 again. It gives us 1%. And therefore, the GBP to pay after 3 months is going to be this 1.494 multiplied by 1 plus 1%. So basically, we are going to need to pay 1.509197. Okay. So now we can compare all of the methods. So we can compare. So we are going to compare here the amount to pay and the forward rate under the option. The option, we are going to compare both methods, the one of 1.6 and 1.62. Then we have the money market hedge. Okay, so the forward rate, the amount payable was 1.500. Then the option of 1.6, 1.519, option of 1.62, 1.512, money market hedge 1.509. So which one are we going to choose? The forward rate. Okay, we choose the forward rate because it gives the lowest payment in pounds. Okay, but now for advanced level, we say, however, the forward rate may not be available. But of course, this one may not be relevant for this question because really these are dollars and pounds. Those are available. But there are some cases where they give you some currencies that are not very common. So you would say, okay, that the forward rate may not be available because it's over the counter. Okay, so that's why that may not be something that you can use. And also there is default risk. You know default risk?
I beg your pardon.
Do you know what default risk is?
No.
Now, when you have over-the-counter contracts, remember we have entered a contract to exchange like in 3 months' time at a given rate. So you could go to the bank and say, okay, I want to exchange, and they will say, don't have the money. So it's a risk that the counterparty may not satisfy the contract terms. So that's default risk. So it happens with over-the-counter things, but when you are looking at the ones that are traded on the exchange market, those ones don't have that problem. So that's where we come and say, okay, Macha's forward rate is better because of that fact that it may not be available. You may go for money market hedge, which is the next option, but also there's default risk. Okay, and money market hedge also suffers from default risk because it is also over the counter in a way. Now, options, of course, give us the option to not exercise when the rates are not moving in our favor. So we may also talk about that part. But of course, just in terms of determining what to do, you choose the lowest amount here. So we are going to use the forward rate. So when you did last time, did you go through these steps?
For the money market, I had done it in reverse.
But you get the same figure.
Yes.
Yeah, so you don't have to change your method on that, because even me, although I laid them like this because that's what makes sense, I do them also in reverse. I start from step 3 going upwards. So you don't have to change your method on that. You can just keep doing what you've been doing. No problem. Okay, so that was the first part. So then now they're saying for the second part, calculate using a tabular format the impact of undertaking multilateral netting. So for multilateral netting, we saw it yesterday. What we are going to do is to, first of all, determine the amounts that are payable from and payable to. For each of them, then we shall determine how we are going to deal with it. So remember, these are the different amounts that are due from and to.
Hello.
Yes.
Sorry to take you back under
Yes.
money market hedge.
Hmm.
Um, are you saying because we don't have the money now,
Yeah.
we borrow,
Yes.
then okay, uh okay, as when we borrow and as hold on. Oh, sorry. No, because sorry. Um, okay, the challenge is I had understood it backwards.
No, no, it's fine. Okay, you see what I said? You're going to have to pay dollars in 3 months' time. So you need to invest so that by the time you have those 3 months, you have those dollars. That's how you understood it, right?
Yes.
Yes. But now the thing is, for you to invest these dollars, you have to have converted some pounds to dollars. And you are going to have to
Oh,
first borrow those pounds. So you borrow the pounds, convert them to dollars, and invest the dollars, such that when those 3 months reach, you have to remove your dollars from the bank and pay. So that's how the logic flows.
oh, is it because the way I understood it is when you're
Mm,
going to pay,
yes,
you invest your money, then as your money, I don't know, accumulates with interest, and when it's time to pay, you
yes.
convert it. Oh,
No, 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 no. That's not actually how it works, because you convert now. The whole purpose is for us to convert now. So if I'm going to pay dollars, I need to convert to dollars now because I don't know what's going to happen to the rate in future.
Or
So
you convert now to prevent the risk of the rate
yeah,
going up or going up since you're paying.
yeah. So you convert now.
Oh,
And the only way
okay.
for you to convert now is that you have to first borrow some pounds because you don't have the money. That's what you assume. You don't have the money now. So you have to first borrow it, then convert, and then invest. Okay? But as I said, if you have understood it the other way around and you get the same answer, you don't have to change your methodology on that. Because even you see me when I'm doing it, I'm starting from down going upwards. Because I need to first know how much dollars do I need to borrow or to convert to. Okay, so as long as your method that you remember, in the format that you remember, it gives answer, don't worry about it.
Oh, okay.
So now we go to this matrix. So what we are going to do is like we did yesterday, odd by odd to. So now odd by, now for the odd by we have Kenduri, then we have Goshik, Goshiko, is it Goshiko? Goshiso. Then we have Jaya and Lakama. That is odd by. Then on the odd two, we have Lakama, then we have Jaya, then we have Kenduri, and then we have Gosisho. Those are the people, those are the companies. Okay, so now, so if we start Kenduri, it owes Lakama 4.5 million. Now they told us in the question that when we do the multi-level netting, we are using pound as the base currency. So need to convert these dollars, pounds. And the rates they told us to use are here. Let me just erase some parts of so that we can see them very well. Here are the rates that we are using. So $1, 1.5950 for £1. So means that we are going to have to convert this 4.5 million. So the currency here is going to be, let's work in millions. We are going to work in millions, which means that I'm going to have 4.5. Now this 4.5 is in dollars. So to convert to pounds, I have to divide by 1.5950. That becomes 2.8. I'm just going to work in pounds without the millions because I don't like these decimal places. So let me just Let me just make this 1 million. So that's the amount. So let me just, okay.
First, hold on.
Yeah.
In the question, because
Mm.
I think I also did like that when I was trying out the question.
Yeah.
But there is some part of the question where they say, I think payment is based on, I think, the currency of the country. I didn't know somewhere in the question.
Mm,
Somewhere in the, I think it's up.
up.
Yeah.
Where they are using multilateral rating from UK with the sterling pound as the base currency. And if the
Let's hold
multilateral
on.
rating is undertaken, is it there?
I remember reading it somewhere.
But you see, okay, you're saying that they did not use companies, they used countries.
Okay, that's the part that confused me because initially I think I did the same thing you were doing. Then when I tried to just check, it seemed they based on I think currency of the receiving subsidiary. I don't know if I remember as if I saw it somewhere in the question or I was just mistaken.
I don't remember seeing it in the question, but what we are doing is similar to what we did yesterday. So,
Mm.
okay, I just put this figure. Let me put this figure in the right place. Uh, Maybe I can move this thing so that there's no space there. But okay, let's do this because this is okay. Then we shall see what the solution is saying. But let's first do what we did yesterday. Okay.
Okay.
So yeah. So Kenduri to Lakama, we have converted it to dollars. Then we can now also look at Kenduri Jaya. This one here. So this one is in Canadian dollars. So how do we convert? So again, we are going to have to divide by 1.5700. So we are going to have the figure is 1.1 million, then divide it by 1.5700. That gives you 700. Then now Kenduri doesn't owe Kenduri. Okay, so here there will be a space. Then we go to Goishisho. So Kenduri, actually there's no Kenduri Goishisho here. So that means also there's nothing. So there are only those two for that first line. Okay, so then we go to the next one. So next one is Goishisho. So for Goishisho, it has Goishisho with Jaya and then also with Lakama.
Hello.
Yeah.
The 0.7006 isn't it? Isn't it? Let's hold on.
The 0.7006.
Oh, it's okay. It's okay. It's fine.
Okay. Okay. So then Goishisho is here. Uh, so it has Jaya 3.2 million. So here 3.2 million divided by, because it's also in Canadian, so we divide by 1.57. That gives you 2.038. Then Again, go show with the Lakama, $1.4 million. So here, $1.4 million. So we divide by the rate for dollars, which is 1.5950. That gives you 877. Then, so Goesho doesn't have any other one here, which is owed, which is owing to. So then we go to Jaya. So Jaya has with Lakama $1.5 million. 1.5 divided by 1.5950. That's 940. Then Yaya also has with Kenduri 3.4 million. So 3.4 million divided by the rate for Canadian is 1.57. That gives you 2.165. Then I think now we go to Lakama. So Lakama with the Goesho 320 million Japanese yen. So here 320 million. So the rate for Japanese yen is 132.75. So that gives you 2.41. And then also Lakama with Kenduri, 2.1 million. And that is $2.1 million. So divide by the rate for dollars, which is 1.5950. So now these are the amounts. So now, if you want to know how much Kenduri Co is owing, basically you add up. So it's owing 3.5. So you drag down. So 2.9, 3.1. So those are the amounts that Kenduri is owing. 3.5. Westcho is owing 2.9. Jaya 3.1. Lakama 3.7. Now, then if you want to know how much is owing to Lakama, you add now these ones. You add it going back up out like that. So 2.7, 3.4, 2.4. Okay, and then 4.6. Are we understanding those totals?
Yes.
Yeah. So now in yesterday's question, they had given us the order of payments, but here they did give us the order of payments. So we can just say what is, because when they are going to net now, Lakama Co, you know that Lakama Co is owing 3.7, right? But
Yes.
is owed 4.6, which means that Lakama is actually going to be having a receivable of 912, a net receivable of 912. That is Lakama. Then Jaya Co is owing 3.1, but is owed 2.7. So it's going to have a net payable of 367. Okay, because is owed 2, only 2.7, but is owing 3.1. So it will have a net payable of 367. Then Kenduri. So Kenduri Co. Again, Kenduri is owed to 3.4, but is owing 3.5. So there is a net of 39,000 that he has to pay. And then we have Goshisho Co. Again, this one is owing to 2.4, but is owing 2.9. So he has to pay an extra 505. So this is how it goes. And of course, when you add up everything, get zero because they have netted everything through. See? If you add everything, you get zero. So this is what we did yesterday. Although the presentation is a little bit different from yesterday, but we did the subtraction again yesterday. Remember what we did? Just that the table was arranged a little bit differently. If you look at the table, we first put the owed and the owing, then we subtracted. Okay, but it's basically the same thing we have done here. So that is the netting part. So now the question asked us to calculate, but also it asked us to say why some governments allow it and others don't. So do you think why do some governments allow it?
Yes.
Why do you think some governments allow it and others don't?
Um. I think. I think some governments don't allow it because of the risks that come with the netting of a. Any, I've forgotten.
Okay,
Sorry.
okay, it's fine. The problem why they don't allow it, you see what has happened here? We have only converted, this has been handled centrally. So it means that,
Oh,
you
sorry.
remember it?
Yeah, I think some governments don't allow it because of the length of time it takes for settlement
Yeah, a lot of time.
in some cases.
Yeah. So because it's done centrally, but also, uh, you see, because if each country was doing it on their own, they would be getting foreign exchange through the bank fees. But
Yes,
if it's done by one central, like Treasury Department in the UK, for example, then they will lose those fees, the bank fees for those transactions. So that's why the governments don't allow it. But the reason why other governments allow it is because it is cheaper for the companies. And that means that it is going to encourage companies to come and invest in countries that allow it. So they benefit from getting more investment. So that's why, basically. So maybe I can write it here that when you are looking through, maybe some governments don't allow alternating because it deprives them of the bank charges for the FX transactions, which they would get had it been each country handling the FX on their own. That is the one for not allowing. So some governments allow it because it is cheaper. Companies and therefore enables them get more investment, or therefore enables the governments, because usually better to make sure you are saying what you are saying. So enables the governments, not the companies. Enables the governments get more investments. Okay, so they can, let's say, more foreign investment. That's why some governments will allow it.
I
Okay.
beg your pardon on the
On
part where
which
you
one?
say that some governments don't allow it because it deprives of bank charges from forex transactions, which they would have
Yeah.
would they would get had it been. Oh,
So let me just make it bigger so that you can read it properly here. You see, the thing is, when there is that netting, it is being done in one country. So all the transaction costs for that netting are going to be earned by that country. But if they had not allowed that, then you would be doing this transaction like we did for the first calculation, where we pay the premiums and all these things. All these costs would be seated in the country where that transaction is happening. So that is where I've said that they deprive them of that bank charges and for these transactions. So, but the other governments also still have that problem, but for them they feel it's okay because the investments that they get should outweigh how much they are losing from those bank charges and all that. So those are the two explanations for why some countries allow and some countries don't allow. So I hope that this question has now made you okay with dealing with FX hedging. Because
um, hello.
yeah,
Okay. I think I've seen where my issue was when I tried to do the multilateral knitting
yeah. What was the
part.
issue?
It's because I hadn't got the correct summation of the amount uh owed to.
Okay.
That's but then I'd like to ask,
Mm,
um the okay, when I went back and checked the answers
yeah.
in the question, I wanted to get a proper understanding whereby, like yesterday, how you explained that because companies, so ABC had maybe the largest amount
Yeah.
uh, owing to, it would pay this percentage first to,
Yes. Mm,
yes, to a certain company.
mm,
So here, when we've gone through the question together, you got a summation of the
mm.
figures and it gave us zero, meaning
Yeah.
that you explained that they've actually done the netting
Yes.
already. But then one thing I'm not getting is when you go to the answers,
Mm,
they explain uh, that in terms of how the payments will be made amongst the okay, how
subsidiaries.
the payments will be made with the different subsidiaries to Lakama, which I'm failing to connect.
Okay, let's go to the solution. But before we go to the solution, the question, for instance, they had that in the question itself. They had said that the company owing the highest amount will pay the country, or the company owed the least amount, and that's why if we look at it here, Messi was the one owing the highest amount, right?
Yes.
and Horan was the one which was owed the least amount. So Messi first paid the Horan the 5.21, and then the remaining part, which was 6.35, it paid it to Armstrong. And then also Giffen paid this amount to Armstrong, because even yesterday I didn't show you the summation, but it still comes to zero because the netting would have scattered for that. In today's question, they didn't tell us that, they didn't say who pays first. All that matters is that at the end of the day, but in this case, actually, Lakama is the one which is actually having a receivable. You see, a net receivable. So which means that all of these guys are going to pay Lakama. This case. But let us look at the solution and see what they explained. Okay. So they're saying that each of Kenduri's, Jaya and Goshan will make payments of pound equivalent to the amount given above to Lakama. That's what I've just told you here, because in this case, Lakama, remember Lakama is the one who has a receivable, but these guys are all having payables. So I think it makes sense why it's Lakama receiving in this case, right?
Yes.
Yes. That's what they're explaining. I hope so. There's nothing else they are saying about that, because this is all that has to be said on that payment. For yesterday, there was two people who had receivables and people who had payables, and they had told us how the payment should be. The one with the highest payable pays the one with the lowest receivable first, then finishes the other guy, and then also this guy sends the other guy. So that's the difference between the questions for yesterday and the questions for today. I hope it is clear now.
I wanted to get just to get a more understanding. So, for example, basing on yesterday's question,
Yeah,
Mercy had the largest debt, and also
yeah,
Gifton. Okay, followed by Gifton.
yes,
So, in your explanation, you are saying that Mercy will pay. It will pay Horan
Oran.
because it has the smallest debt.
Yeah,
Then, out of how much it has paid, what is it remaining with? So it's remaining with 6.35
yes,
as an amount payable. So that
yeah.
remaining figure will go to Armstrong
Armstrong.
because it's due to
Mm.
receive.
Yes,
Now, out of the amount, the 11, out of the out of the
the
sorry,
9.46.
out of the 9.36, uh, um, out of the out of the 9.36,
Mm.
Armstrong is left with 3.01.
Yes,
So since Gifton is paying and Armstrong is receiving, that
yeah.
means that 3.01 will
Mm.
will be
Got
paid to
Armstrong.
Armstrong.
Yes.
Oh,
And
okay.
what you have explained is because the question had told us to do so. Okay, maybe I can show you the questions that you know we are doing like that because the question was set like that. That told us. Hmm, so the question said that settlement will be made in dollars,
Oh, sorry.
the parent company settlement will be, yeah,
Sorry. So for today's question, you say
Yeah.
that when you take a summation
Yeah.
of the amounts and the amounts that are due to be paid,
Yeah.
you end up with an amount of 0. So you explain that actually they've been able to net off. So
Yeah.
since in this case, Lakama is the one receiving and the other ones are paying,
They all pay.
instead they'll make payments to
Yeah.
Lakama.
Mm.
Oh, okay.
Yeah.
Okay, it's fine now.
Okay. Yeah, that's good. So now what I'm saying that I hope that now FX is clear. If you want, because this is a good time, if you could go and read those parts. Did you manage to access the portal now? The study hub, or you have not yet tried?
Um, I haven't yet got a chance because my Monday and Tuesday were really busy with meetings. But I'm going to go through it tonight. Hello? Hello?
Yes, Donna. Yes, Donna.
Oh, okay.
Mm. So tomorrow, would you want us to look at another FX number or interest rate?
Um, uh, probably another FX number.
Okay. Okay. So let me look for another FX number. I share it with you so that we look at it tomorrow.
Oh, okay.
All right. So I think today we are going to stop here. Have a good night. See you tomorrow.
Okay.
Mm.
Thank you.
Mm. Welcome. Bye.
Bye.